Time now to bring on board Santanu Sengupta, the Chief India Economist at Goldman Sachs, to understand what we can expect from the CPI print later today. Santanu, thanks so much for joining us and good morning. Give us a sense of what you are expecting when it comes to the CPI level, because largely when you take in the street poll, it's estimated to come in at levels that we had last seen in August 2019. So, it's looking healthy, is at least what the street is estimating. What is your estimate, and what would you say is the tolerance band that we could see for the CPI figure this time?
Yeah, thanks. Our estimate is not very different from where the street is. We are slightly less than the street forecast at 3.1%. And indeed, if this materializes, it will be a 6-year low for headline inflation. The main driver, again, is food prices. We are seeing food inflation quite benign. Again, a sequential contraction in food prices on a seasonally adjusted basis. And we think that it comes around 2%, which will again be around a 3.5-year low on food inflation. Core inflation is unchanged in our view at around 4.1%.
All right. Hi, Shantanu. Also give us some sense that with respect to the rainfall predictions, that expected to be healthy. An early rainfall is what the IMD is projecting with, and overall the season is expected to bode well. What implications could it have to food inflation? And with respect to these projections, how are you adjusting your estimates?
Right. So I think the main point is that on a yearly basis, if I look at the next 3 quarters, we are looking at sub 4% inflation on a headline basis, and food inflation likely in the region of 3.5 or even lower. The big movers are pulses and cereals, to an extent, oilseeds. Pulses, although domestic production actually has lagged for a couple of years, our imports have been quite good, and therefore, you're having pulses inflation in the negative now. We expect it to rise slightly, but not be significantly high. Both for rice and wheat, the sowing has been good. Rice, particularly for Kharif. On wheat, the production estimates, as per the advanced estimates, are pretty decent, and you have had a 6% increase in MSP. So overall, we are expecting wheat also to be relatively contained. And on the oilseeds part, you're right now seeing pretty high inflation, but that is somewhat driven by a high base, and we expect that to come off because globally palm oil prices we have seen coming off. I think the high vol item still remains vegetable prices, and vegetable prices this cycle, at least in the last 3 or 4 months, have been remarkably contained. Despite heat wave warnings from the IMD or even the maximum temperatures reaching above the normal estimates. Historically, our research has shown that this typically results in vegetable price spikes, and therefore you have these episodes of very high vegetables inflation or perishables overall inflation. But we just see this as remarkably contained this year, and therefore in this cycle, and therefore think that overall headline will remain sub 4% for the whole year.
Point taken, but while all of that is on the CPI print, also give us a sense on what you're expecting on the core CPI print, excluding food and energy. We've had a lot of geopolitical factors at play. We've had some supply shocks as well on the back of tariffs. Help us understand if any of this could have any impact on core CPI. And while we are expecting CPI at 4.27%, what's your projection for the core CPI figure?
Well, the headline number in our view is 3.1 for this month. On the core CPI, look, we think it's going to be contained around 4% or early 4. I think there are two things happening. One is that oil prices have come off quite significantly in the past 3 or 4 months. Our expectation is that it remains around $60 a barrel, even with the temporary reprieve that you're seeing in US, China, the tariff deal, even with slightly higher growth. We think that oil prices will still remain contained in a $60 kind of range, which ultimately feeds back into core inflation. The other thing is that if indeed US puts up trade barriers on China, there's a possibility that the China oversupply hits regional markets later in the year or early next year. And that could cause goods inflation, core goods inflation, to come off in the second half, late second half or early next year, which is why we think that core inflation also in this cycle will be relatively contained at around 4%. Finally, on the domestic front, it's difficult to imagine core services inflation being materially high. Your domestic growth is such that you're not really running large positive output gaps, and therefore wages inflation really should not feed back into core services, at least over the next 2 or 3 quarters, is our view.
But with respect to the rate cut specifically, how the analysts are now anticipating, especially in the US markets, they are projecting the next rate cut to happen in December. They are making some adjustments to that. But what are your views on the Indian markets? Where, how much and when do you see the rate cuts actually getting implemented?
Yeah, so on the Fed, our U.S. economists yesterday changed the call on both growth and Fed and the recession probability. So we have a slightly lower recession probability now than earlier at 35% versus 45% earlier. And also they've raised their growth estimate given the temporary reprieve that you're seeing on U.S.-China trade deal tariff talks. Our Fed call has been pushed towards December now from July earlier. We are now expecting Fed rate cuts in not in consecutive meetings, but with a 1 meeting gap in between. Our RBI call doesn't change. We still think that the RBI cuts twice more, 25 each in June and August meetings. And takes the repo rate towards 550. Look, if inflation at a headline level is running at around 3.5%, we think that the RBI has enough room in terms of the real rates to take the nominal interest rate towards 550, nominal policy rate towards 550. It still provides the RBI with a significant buffer. As you head into the first half of next year, what inflation projections are is going to be important in terms of determining how much deeper the RBI can cut. So for instance, if the first half of next year, headline inflation is still below 4%, despite the very strong base of this year, that is when the RBI, we think, can cut deeper. As of now, our projection is that you get into 4% or early 4% maybe in the first half of next year. And also growth news in the recent past has just surprised a little bit on the upside, mainly from US and China, and therefore we think that 550 for the repo rate for India is appropriate.
Point taken. Shantanu, lovely chatting to you this morning. Thanks so much once again for joining us and sharing with us your outlook and your estimate on what the CPI figure that we're expecting later today could be. Thanks once again for joining us.
If you like this video, then like, share and subscribe to ET Now.